All right. Good morning, everybody. It is the stroke of 11. We want to be prompt and respectful of everybody's time. Um, Glad you all made it. Thank you for coming. This is Mark Salter, the Executive Director for CFA Society Minnesota. I'm going to get out of the way and turn it over to Chris May, our CFA Society Minnesota President. Chris, all yours.
Can you hear me?
Yep, I can hear you now, and I'm going to turn off my camera. Bye.
Technical difficulties, apologies. Like Mark said, good morning and welcome again to our first significant Zoom meeting. Appreciate you guys taking the time and bearing with our, or at least I'll say my own incompetence as it comes to Zoom meetings. Despite the move to a video event, I can't tell you how excited I am to actually be participating in a CFA event again. If I squint a lot, it starts to feel more normal being able to see some other people. So appreciate the break from the 8x8 box that I've kept myself in for the last bunch of days. In terms of structure, Mark talked about it. We're gonna have some prepared remarks at the beginning. I'll moderate the Q&A through the group chat. So if you have any questions, please send messages that way. I'll try to collect and combine questions and ask those to John and Jason after the prepared remarks. If you don't ask any questions, then you're gonna be stuck with the questions that I ask, and I don't think you want that. So please send anything that you wanna ask, and we'll get to that in a little bit. I'd also like to start by introducing John Taft. John is the Vice Chairman of Baird and a member of the firm's executive committee. Prior to Baird, John was the CEO of RBC Wealth Management for more than a decade. He's also the author of 2 books, Stewardship, Lessons Learned from the Lost Culture of Wall Street, and A Force for Good, How Enlightened Finance Can Restore Faith in Capitalism. Welcome, John. Thanks for joining us today.
It's my pleasure to be here, and it's doubly my pleasure to be able to introduce my colleague, Jason Trennert, to the Minnesota community of financial professionals. Jason is the Chairman, Chief Executive Officer, Chief Investment Strategist at Strategas, which he co-founded in 2006. The firm now employs over 50 analysts, institutional salespeople, traders, and 3 offices, and is the top-rated all macro research firm in America. Prior to founding Strategas, Jason was the Chief Investment Strategist and a Senior Managing Director at ISI. His presence in the media is ubiquitous. The only word I could come up with, Jason. You're everywhere all the time, or one of your people is. You can't turn on the TV these days or read a publication without seeing somebody from Strategas opining about what's going on, which I consume their intellectual content many times a day, and it has really helped me navigate this incredibly unusual environment we're all in. Jason himself is an author of 3 books about investing and the investment business, including, I have to say, my favorite, My Side of the Street, published by St. Martin's Press in 2015. He's a member of the investment committee of the Rockefeller Brothers Fund. He has an MBA from Wharton, BS in International Economics from Georgetown. He sits alongside me on the Baird Executive Committee. Baird purchased Strategas in January of 2018, which is coincidentally the same month I joined the firm. Well, since this is the CFA Society's Putting Investors First month, we originally positioned and titled today's event, which was to be an event, in-person event, obviously, as Humanizing Wall Street. But given everything that's happened in the intervening months, we thought it would be more appropriate to hear from Jason about his point of view and Strategas' point of view about what's unfolding in society, in the global economy, in financial markets. Jason's going to speak for 10 or 15 minutes. Now, I have some starter questions I'm going to ask him. And Mark is going to open up the lines in the chat room. I guess it's the chat room to everybody to send your questions to Chris May. Chris is going to feed them to us. And then we'll wrap up by talking a little bit about the original topic, which is finance as something that should be a force for good in the world. What is the role of finance in the current environment. So Jason, thank you for joining us today. It's my pleasure and honor to introduce you to my colleagues and peers in Minnesota. Welcome.
Thanks. Thanks a lot, John. It's my it's my great pleasure to be with you all. We have a number of clients in Minnesota. I've been doing this business pretty much since I got out of college, so about 30 years. And so I've been to Minneapolis many times to see our clients there. And I know we were scheduled for me to be there in person, but this is, I guess, the second best thing. And what I'll do, as John pointed out, I'll go through maybe some just big picture ideas about the economy, about the markets, about politics, perhaps a little bit, and about just the way the future may change as far as society is concerned. It's a lot to go over in 10 or 15 minutes, but it should give us plenty of raw material for questions and answers later on. So, the first, obviously, I think it pretty much goes without saying that the U.S. is in recession right now. As you may know, there's a very specific definition of a recession that's laid out by the National Bureau of Economic Research. Then there's the heuristic that people use, which is 2 quarters in a row of negative GDP, almost no matter the way you look at it. You're looking at a pretty deep recession. If you just go through the numbers of the workforce and the labor force, there's about 150 million people in the labor force in the United States right now. 50% of them are in small and medium-sized businesses, so about 75 million. If you just X out bars and restaurants, that's 12.5 million people. And then if you were to add on top of bars and restaurants, leisure, so hotels, airlines, travel, all the rest of it, you get to something like 17.5 million people. So it's not hard to see how you could have a double-digit type of unemployment rate before this is all over. This is really, a lot of strategists tend to say something's unprecedented when they don't know what's going on. This is truly unprecedented, though, because you've never had a period where the government's largely shutting down the economy and encouraging people not to spend money. So this is different. It's not like anything we've ever seen. It's unlike anything we've ever seen before. The unemployment claims numbers that you may see that come out every Thursday, in my opinion, are probably one of the most important things to look at in this process. I've always felt that they were among the best economic indicators to look at, and that's mainly because they're a count of the number of people that are applying for unemployment claims. And if you spend any time with some of the other government economic data, you'd find that it's highly processed. It's highly, there are a lot of assumptions being made. There's a lot of statistical models that enter into it. Whereas unemployment claims, for the most part, are literally a count of the number of people applying for claims. And you might have seen in the last 2 weeks, you had 6 million people file for unemployment claims last week. The prior week, it was 3 million. The prior peak, I think they've been doing these numbers since the late 1960s. The prior peak was in 1982 of 685,000 people applying for initial unemployment claims in any given week. So you're an order of magnitude higher today than you were at the worst period in the past 50 years. So no question, this is the real thing as far as a recession is concerned. So I'm starting out with what you already know. If there's good news in this, is that we get this question a lot. Is this going to be a depression? I mean, the numbers you're laying out are pretty severe. And the good news here is that I would say the magnitude and the speed at which the government is moving is such that I think a depression is extremely unlikely. And the recession, while it might be very deep and painful, may not last all that long. There was some discussion a couple of weeks ago about whether this would be, people talk about the letters, would it be a V-shaped recovery, a U-shaped recovery, a W, square root, there's all these shapes that people come up with. I'm kind of more in the square root idea, which is to say that, we're down a lot, we'll bounce once you start opening up the economy again. And then it's going to take a while. You'll be flat for a while as you deal with some of the, especially the fallout in small and medium-sized businesses. But the only real, I would say the only real example we have in the modern era, if you want to call it that, of a depression is the 30s. And I would argue that if you look at what the government policies were in the 30s compared to where they are today, it's night and day. Which is to say, in the 30s, we literally made every policy error you could make simultaneously. We raised interest rates to stem an outflow of gold. We actually increased taxes on corporations. There was an undistributed corporate profits tax. We actually raised the top rate on marginal income tax earners. We increased regulations dramatically, particularly on the financial sector. And then we had a full-blown trade war. So Amity Shlaes wrote a book called The Forgotten Man, and one of her main contentions really was that government actions in many ways did more to lengthen the depression than shorten it. And I'm very sympathetic to that idea. And the good news now is that it's quite the opposite. The Fed's balance sheet, as you may know, or if you've been keeping track, it's close to $6 trillion right now. It was about $800 billion before Bear Stearns failed. It was maybe 3.8 trillion about 2 years ago. So the Fed has abilities to buy securities that it never really had before and is using them. You might have seen the fiscal stimulus package, $2.1 trillion, and that's unleveraged. There's about 400 billion of that can be given to the Federal Reserve, which can be given to banks and then levered up. So you get something like $4 trillion of leveraged spending out of that. So pretty amazing stuff, especially given the fact that this really, it's hard to believe, only started about 3 weeks ago in terms of the general shutdowns of the economy. Pretty remarkable how quickly this is moving. Then on the regulatory side, I do think you're getting some easing there, particularly on banks in terms of what are considered bad loans or what's considered capital. Those are very welcome. FDA regulations are easing. So the only thing the government's probably not doing that it could be doing, but I would say is doubtful, would be easing tariffs. And of course, we had a trade war last year with China. In a strange way, the president has the ability to give himself his own rate cuts by cutting tariffs. But I think given the politics of this, it's very unlikely to see that happening. We are deferring import payments from China for 3 months. So that's something. But anyway, long-winded way of saying recession for certain, depression extremely unlikely because we learned the lessons from the depression and we're moving very quickly. I would also say it would not in any way. I would say it's very likely you're going to see another fiscal stimulus package in the next several weeks. That one would probably be another $1 trillion, if not more, and would be very much directed towards the state governments, state and local governments, because clearly there, as you may know, there's about 10 states that don't have any state income tax, and now they practically speaking don't have any sales tax either. So there's some very big holes to be filled at the state and local level, and so at least I would say Congress and the administration understands that, and so help is on the way. I'll keep going here, and I promise maybe 4 or 5 more points, and then I'll open it up.
Take your time. Take your time. All right.
Yeah. Okay. See, then the question then is, have we seen the bottom? I have to say in the S&P 500, I have to say being candid, I'm not sure I feel particularly comfortable with the rally that we've seen over the last couple of days. And the reason why I don't feel particularly comfortable with it because there's still so much we don't know in terms of when the economy can open back up again. It makes it very hard to forecast what earnings are going to look like. We're using $139 for S&P 500 operating earnings this year. If you put that would put those at trough earnings. If you put a trough multiple on that of 13.5, which is what we saw in December 2018, you'd get something like 1900 as the low on the S&P. I don't think we're going to get there, my own opinion, but there's something that makes me feel a little uneasy that we're getting up to 2650, 2700, something along those lines. When we have very little information as to when the economy will open up again. So I would imagine there's going to be more backfilling. When you have bear markets, you can have very, very strong bull market rallies, or you can have bear market rallies that are very significant during these periods. And I think, again, until we know more about what's happening as far as the virus and when we can open the economy back up again, I'd be careful about putting a lot more money to work at these levels. If you got more down to where we were before, it's my own opinion, 2,200, 2,300 on the S&P, I'd be much more interested in putting money to work there. It may be too early to talk about what things are going to look like on the other side, but we did take a look at the last 9 recessions, and we looked at what industry groups did the best. And we came up with 6 that outperformed coming out of the last 9 recessions on average. Entertainment, aerospace and defense, airlines, metals and miners, consumer finance companies, and truckers. Those tended to be the best performing industry groups coming out of the last 9 recessions. This one may be a little bit different. One of the things that surprised, I think, a lot of our clients is that some of the most high quality names actually haven't done particularly well. And I think that's partly because the dividends are very much under question because, again, the nature of this recession is so different than anything we've seen before, where you don't really go down to zero too often. It strikes me, though, as time goes on and we open up the economy again, the more high quality, higher yielding stocks will start to do a bit better, and the more cyclical stocks, as opposed to growth, may start to do a little bit better as well. But I think it's probably too early as far as that is concerned. Technically speaking, we do have a technical analyst by the name of Chris Verone, who's excellent. And I think when, there's just like there's no atheists and foxholes, there's no non-technicians when the market gets completely obliterated, So, we spend a lot of time on technicals, even just on regular days, but especially when you're looking here, you're spending a lot of time looking at charts. The good news is that I would argue that the VIX has come down on successive days. That's a good sign. The breadth has improved dramatically. I think yesterday was a 12-to-1 up day as far as volume is concerned, so that's good. And you just don't have the types of indiscriminate selling that you had a couple of weeks ago. The correlations are starting to come down, which is good, because that's what you want to see. You want to see some sort of dispersion between the way the market is treating assets. The problem is when you get in severe stress, of course, so sometimes the best assets get sold first because they're the easiest ones to get bids on. And the fact that you're starting to see more discrimination in that regard, I think, is quite good. And maybe the last thing I'll touch on here, be happy to take any questions you might have on all sorts of things. But I'm trying to figure out what. Maybe I'll 2 more questions. One would be on the losers and maybe the election too. And I don't want to offend anyone's politics on the election, but I do think it's important to talk about. In terms of the losers from COVID-19, because things are going to be different, I think, after this, geopolitically and politically and socially. I take no pleasure in saying this, but I do think globalization, generally speaking, is going to take a hit. And I think that it's important to think about that because I think it's fair to say that globalization was a big driver of stronger growth and lower inflation over the past 20 years. I think to the extent to which there's going to be less globalization as a result of this, in my opinion, one would have to think that growth might be a bit slower and inflation a bit higher. China, in my opinion, has taken an enormous hit as a brand. And there's very little question that there are a number of industries that will be onshored back to the United States, not because it's necessarily good economics, but because it's strategically important, right? So having 85% of your antibiotics produced in China, for instance, is just, politically speaking, it's not very, very unlikely to continue. I would watch the euro as well. I think there are real cracks developing in the euro, particularly between North and South. I think Italians in general have felt underserved by the Eurozone, at least thus far. And so there's a lot of catching up that's going to have to be done. Otherwise, I do think the populist movements there are going to continue. Another couple of losers, I would say, is illiquid alternative investments and private equity. I think, all my clients are public equity people, so it's easy for me to be critical of private equity without much career risk. But frankly, I've always been somewhat skeptical of the very heavy allocations to private equity by state and local governments and pensions, endowments, and foundations in the past. And I think there's going to be more skepticism, more widespread skepticism now, because a lot of that dry powder is probably going to have to be used to shore up operating expenses at their portfolio companies as opposed to new acquisitions. My own opinion. Last thing I would just say, as far as the political race is concerned, of course, it's anyone's guess. If 6 months in U.S. politics is an eternity, I will say President Trump's approval ratings are close to all-time highs as to his entire term. So it's a 50-50 country. Before COVID happened, when we would talk to our clients, we would regularly do surveys. And this disturbed me a bit. About 85% of our clients thought that President Trump would be reelected. Now, they didn't say by what margin, but 85% thought he would be reelected. That scared me just from a contrarian point of view because it's a 50-50 country. And so I would kind of bet that I would have bet that way as well. But, I'd say he's likely to win, but he'll win. If he wins, he'll win 51-49 or 52-48 or something along those lines. I think when we talk to our clients now, it's still, people tend to give the benefit of the doubt to the president to win re-election, but it's come down. Clearly, it's come down to more like 60 to 65% think that he's likely to win. And I do think, again, without getting overly political about it, the only thing that would scare me about perhaps a President Biden administration would just be that some of the tax cuts that were passed a couple of years ago, particularly as it related to capital spending, might be very much at risk. And so, but the politics of this thing are such that, you don't know, and people might favor that. So I just put that out there. I droned on, I think, for about 15 minutes, maybe more. But I'm happy to stop there. There's a lot of things we didn't chat about, and hopefully perhaps I could answer some questions about those.
Great. Thank you, Jason. I've got a couple of questions just to kick things off, if you don't mind. You and your team have written that we're all Keynesians now, and have pointed out that prior to this crisis, modern monetary theory was a crazy wacko idea of the progressive left or whatever. Not your wording, but in essence, we are in a modern monetary theory world. Deficits don't matter. Throw whatever resources it takes at this problem. Do you worry about, talk about getting to the other side, what it looks like, how you unwind this?
Yeah.
What are the long-term implications for America and the world?
Listen, John, it's a great question, and for those of you who might not be that familiar with the concept of modern monetary theory, if I were going to sum it up, it's basically the idea that if you have a reserve currency, you can spend whatever you want. There are really no practical constraints. And this was something, there's a professor out of Stony Brook in New York who was advising Bernie Sanders, who was very much a proponent of this idea. My own particular feeling is that there's nothing modern um, about modern monetary theory. I mean, that this is a pretty standard approach for countries that do have the reserve currency. Pretty soon, after a while, they abuse the privilege and they spend way more money than they need to, and then they eventually lose the reserve currency status. That's as old as humanity itself. There are many other countries that have had a reserve currency besides the United States and have lost it. And so right now, I would argue it doesn't. Now, timing is tough because the U.S. In many ways is bailed out by its competition as far as currencies are concerned. It's hard to see another currency really taking its place, mainly because they're doing largely the same things. But I do think there is a reason why gold has been up over the last 3 or 4 weeks in most currencies. And I think it's partly because people are wondering, and I think appropriately, how you can unwind this. And will there be the political will to unwind all of the stimulus from both the monetary and fiscal side when this is over? It's hard to know. But the record, as we know, has not been particularly great on doing this, and it takes a lot of political will. I certainly don't see anything happening anytime soon. What you are hoping, of course, is that, again, you don't necessarily look for scalps after this is over to try to square the circle or try to balance the budget. You try to do it in a thoughtful way. If you're being very optimistic, it might force real changes, real structural changes to very big parts of the budget, like Social Security and Medicare, defense. But again, that's a profiles and courage approach that seems, hard to find in DC, I would say these days, on either side of the aisle.
Okay. One more from me, and that is I think people who worry about how bad this will get, are we going to move from a deep recession? I enjoyed an article today where you're trying to come up with a taxonomy or a vocabulary that's appropriate for what we're going through. I think it was Don Rissmiller said, we have recession, Great Recession, depression. None of those seem appropriate. He said, maybe we come up with a new phrase like the Great Pause or the global lockdown, which who knows what word we come up with. But those who worry about us moving from recession, let's say deep recession to depression, worry about contagion and things spiraling out of control. And you've written about, your team has written about potential contagion risks, I think, in energy, commercial real estate, and emerging market currencies.
Yeah.
Can you talk a little about contagion risk and how you feel about that?
John, too, this could lead to maybe a little bit what we're going to talk about a little bit later about the nature of Wall Street and how it's changed. And one of the other things that it's hard to see it necessarily taking a hit, but this is one of the problems with securitizing everything in a society, financialization of everything, is that it gets harder to work some of these things out contractually when you get into trouble. Whereas, let's say, and again, this is ancient history, but 100 years ago, there was a big commercial real estate problem. You could go to the local bank without there being commercialized mortgage-backed securities, and you could blend and extend and work it out and hope that you could live to see another day and all the rest of it. And there was an incentive on both sides to doing that. Here, there's an incentive, but the contractual obligations mean that it's much more complicated, and you're going to have to deal with a lot more types of actors, not necessarily local actors, that have their own pressures, their own liquidity concerns, and all the rest. So commercial real estate, to me, worries me the most. It's probably the place where I would say that, and the States is the place where there's going to have to be more, I think, more of a backstop from the federal government. because if you're looking at REITs and all the rest of it, there are a number of institutions that have already said that they're going to stop paying rent, like Cheesecake Factory or something for the month of April. Again, you might be able to get away with that for a month. You start to get into the 2 months, and then the cascade effects become, quite real. Energy is another place where there was, one of the unintended consequences of having extremely low interest rates for a long period of time on purpose is that you probably you incentivize people to take on more debt than they probably should. And you had a lot of zombie companies, particularly in energy, also perhaps in retail, where a lot of companies have probably, in a normal business cycle with interest rates moving more variably, there are a lot of companies that probably wouldn't have made it already, and yet they're still around. And so there's going to have to be, clearly, it seems to me, some consolidation in that space. I'm not sure. Commercial real estate, I could see getting bailed out a little bit more easily, just in terms of money and people understanding the widespread impacts than perhaps the energy industry, which has its own political issues. But you're absolutely right. The knock-on effects of this are enormous, and that's why the length of time that we're essentially shut down becomes very, very important. And that's why I'm of the view, or at least I'm hoping, that there's some more nuanced approach to balancing public health and opening the economy back open again. And not to sound hard-hearted about it, but this is just not sustainable for an economy of this size, given the fact that 50% of our workforce is in small and medium-sized businesses that don't have permanent capital. This could get really out of hand if this lasts a lot longer. And so it wouldn't surprise me in the next 2 weeks if you started to see some sort of plans being rolled out by the administration of kind of a rolling rollout of businesses in some way. People might have to put masks on, or older people might not, of a certain age, might not be able to go back to work for a while, or things along those lines. It seems to me they're going to have to come up with a more nuanced approach to this.
Thank you. Chris, over to you. Hopefully you'll pop on the screen and we'll hear your voice. Questions? I know we've gotten quite a few from the audience.
Yep, several questions have come in. I'm going to take these a little bit out of order because there was a question about zombie companies. And I think the question was asking about if the recession's deep enough to cause significant bankruptcies and maybe shake some of these zombie companies out of the market and free up some capital in the markets. I think maybe the other side of it is, will the government allow that to happen, and should it happen? So maybe take the zombie companies from kind of both sides. How many companies will go bankrupt or would without government intervention, and should they?
Yeah, I think, the thing, and this is one of the other unintended consequences, again, of what we call financial repression or keeping rates exceedingly low for a long period of time, is that in some ways, I would argue that it's actually made, you're lowering rates to get inflation higher. And in an odd way, you could argue that it actually reinforces disinflation because no one fails. So I use Sears as an example, where under any normal business cycle, companies file bankruptcy, even during expansions, because the cost of capital gets too high. They're not particularly good operators, and they get subsumed by somebody else, or they have to go out of business. This time around, that hasn't happened. So if you look at the Russell 2000, believe it or not, before this happened, there were about 38% of the companies in the Russell 2000 that hadn't earned a profit. It's close to an all-time high. And that was largely driven by the fact that interest expense was so low. Now, that helps a lot. Low interest expense, it can help you survive a long period of time, but very few companies can survive without any cash flow or profits for very long. So the first point I would argue is that I think I don't have a number, but the number of bankruptcies, in my opinion, will move higher. Number two, I think it's going to be tough I think to bail out companies that, let's say, would have a very difficult time surviving on their own naturally. I think there's going to be a kind of a pecking order of the companies that were in stronger shape going into this that might get the first look or the first bite at the apple in terms of access to credit, despite what the SBA is doing. And on the other side of this, in a strange way, I don't want to be overly ghoulish about it, but for the companies that survive and do have more permanent capital, they should be able to capitalize on this over a longer period of time to consolidate some of their market share. So in that regard, it's no one thought it would happen this way. Before this, the only way you thought you would really happen, that you would shake out some of the weak players, would be through higher inflation and more variable interest rates. Little did we know we would have this massive deflationary shock where the government essentially shuts the economy down and you get no revenues and no cash flow. Now, no one really in their wildest dreams thought that. I certainly didn't expect that to happen. And so it was hard to figure out how you would solve that issue. And this is a strange way of perhaps solving the issue with the zombie companies.
Okay, excellent. Thank you. There's several other questions. I'll try to get to as many of them as we can. There was a question earlier on about the S&P earnings number that you threw out. The question was about how confident you are in that estimate, especially since so many companies have been withdrawing guidance. And maybe I would say if there's some range of outcomes that you're looking at, that might be helpful to.
Well, and that's a very fair. It's a very fair point. It's very fair criticism, because man, my confidence level on the 139 is not high. I will say that. Now, I did do with my team, we went through the 24 industry groups and we tried to make some basic assumptions. We went through each one of them in terms of how much of their earnings they could retain. And the bottom line was we all did it independently. So we tried to come up with, a view of what the stress testing, the worst case scenario would be. And we were all within 120 and 130 bucks for S&P 500 operating earnings. But that was trying to take a very, a very conservative approach, to the earnings numbers. So I feel pretty good that the bottom is somewhere between 120 and 130. And I think one of the things, if you look at the S&P 500 operating earnings, the thing that's tough is that the makeup of the earnings is very different than the makeup of the economy, if that makes sense. 40% of S&P 500 operating profits come from outside the United States. They tend to be very long financials, healthcare, technology. They tend to be overweight sectors that can withstand this type of disruption better than other types of companies that make up a big part of the U.S. economy. So I would argue there's a strange circumstance under which the earnings could actually come in better. They're still going to be terrible, but they might at the margin look better than what is happening in the real economy. And so I don't know what you get back to in terms of a run rate. We were at 165 last year, which was a run rate. I would say at some point this year, you'll probably get into the 130s as a run rate, and you'll probably split the difference as you get into next year. I'm not, it's going to be hard to get back to where we were soon, in my view, mainly because of the shakeout in unemployment. There's going to be a period of time where you're going to have to heal some of the massive damage that you've had to the overall economy, particularly in the consumer space.
Okay, thank you. There were a couple questions about specific industries. One was asking about the housing market and your views there. Another was asking about oil supply agreements and the outlook for the energy market and what might be sort of an ideal situation for the U.S. as it relates to energy. If you want to tackle either of those, that'd be great.
Yeah, I'll do my best, and I'm a macro guy, so I'll try to give you my opinions for whatever they're worth. But take them with a grain of salt. Really consult somebody who really knows what they're talking about on these. I would argue. Housing, boy, it's hard to get it's hard to get really optimistic here. The good news, you have lower interest rates, so that will help out. By the same token, it doesn't look like anybody's going to be looking for a house anytime soon, and you have lending standards will likely be, I would argue, probably tightened here as well, especially given the fact that the unemployment rate is likely to be higher. Now, there'll be some regional differences and there'll probably be some changes, I would argue, in terms of where people look for homes. I do think this is going to change people's behavior, but I have to say it's hard to get particularly optimistic, at least in the short term, about home building. I think this is, unless you have a contract already in place or something, it's very unlikely that is going to change anytime soon. As far as energy is concerned, short term, obviously this is not a positive development for U.S. production. I do wonder whether longer term this could be good for U.S. production, to the extent to which Saudi Arabia and Russia have not, I would argue, acquitted themselves well as far as the United States is concerned, particularly Saudi Arabia, in my opinion. And there may be more of a bias towards producing more energy longer term here at home. I don't know the answer to that. And a lot of that will also depend on who occupies the White House. But with this White House, I could actually see it resulting in a doubling down of our interest and willingness to be self-sufficient in terms of fossil fuels. Also, again, take no pleasure in saying this, but alternative energy, given just how low the price of fossil fuels are right now, one would think that alternative energy is going to take a little bit of a back seat here for a while, just because of the economics of it.
Okay, fantastic. I think there was one more question that I for sure wanted to hit from the audience, and then I'll end with one of my own before I turn it back to you and John. The other question from the audience was about the role of passive investing in the speed of the drawdown, if you had any thoughts on that.
Yeah, well, now, as you know, the amount of assets in passive exceeds the amount of assets in active. And so I'm not sure how much that has contributed to the drawdown. I do think people should and will start to reconsider their heavy exposures to passive. But again, consider the source. All my clients are active managers, but passive investing looks like a great idea when the market just goes up with very little volatility for 11 years. It looks a little different now, I would argue. I am worried, I have to say, and I do think after this is over, I really do think there has to be a real reevaluation of market structure. I felt that way for a long period of time. Even basic things like reinstituting the uptick rule, or maybe even a Tobin tax on high frequency trading. And I'm not a big fan of taxes. I'm not a big fan of government intervention. By the same token, I feel strongly that capital markets are there to raise capital. They're not, it's not supposed to be a casino. And there is a sense in which you can do some real long-term damage because market structure is geared a little bit more towards people that are not adding a lot to the capital formation process and using this largely as a game. So I would imagine there'll be some changes with regard to that after this is over. But there's no question in my mind that the preponderance of high frequency trading, algorithmic trading, and also passive have exacerbated some of these moves that we're seeing on both the downside and the upside. I mean, you're talking about a $30 trillion market before this all started. 7% moves in any given day are theoretically should not really be a big part of the program, but it's an awful lot of money out there.
Certainly. All right, so my last question was this. Given the pace of change in both what's happening with the virus and government response and the data that we're seeing from various different sources. Can you talk about anything that you've seen in, let's say, the last week that makes you a little more optimistic about what's coming, and maybe take the flip side of that as well?
Yeah, listen, and again, I'm going to try to stay in my lane here. I do think the fact that it does look like the curve, just being somebody I live in Manhattan, and my office is in Manhattan, and I do think to the extent to which it does look like the curve is starting to flatten, and I would say New York is a couple of weeks probably ahead of the rest of the country. I think that is good. I think that's a good sign. I also do think there's more and more people that are unafraid to talk about the trade-offs between public health and economic growth. I think initially there was generally seen as almost a false choice between, well, you're either for profits or you want people to die. And I feel strongly that there's an awful lot of people, particularly the least fortunate among us, that are going to feel massive human effects by an unemployment rate that's over 10%. And so there has to be some more balance in terms of thinking about how you can both protect public safety and open up the economy. And I think the fact that more people are willing to talk about that and consider it and be more creative in terms of the way you would do that, I think is a good thing. You're starting to see that in some of the other countries right now, Austria, Spain, some of the other countries, because they realize that there's just not enough money. It's not sustainable to keep economies shut down indefinitely. So those are two things I would argue that are positive. And when politicians feel comfortable enough opening up the economies again, I don't know. And anyone in a position of leadership is obviously going to err on the side of caution. I think that's appropriate, makes sense. But it seems to me, hopefully, we're talking about weeks before we actually start to roll the economy back up again, start to rev it back up again, not months. And I would consider that a very positive thing. And once people get a sense of when that's going to happen, it seems to me a lot of other things will fall into place, and creditors can start working with lenders and all the rest of it. People can start working some of these things out. So at any rate, I hope that was helpful.
Yeah, that's great. Thanks. John, I'll turn it back to you to wrap up with the humanizing Wall Street part that we originally planned on this event being. Mark, it looks like John's muted again.
John, I think you just have to touch your screen there. There you go.
Okay, back on. Jason, 5 minutes back and forth on humanizing Wall Street. I guess let me start. I wrote an article. It's looking for a home just recently. The title is "This Time Really Is Different," recognizing that those are the most dangerous words in finance. But comparing 2020 to 2008, they are two very different situations, obviously, and the role of the financial markets in 2008 Great Recession versus the 2020, whatever we're going to end up calling this, are very different. But as I look at what we're going through right now, I think one of the narratives that hasn't been picked up on is that, at least so far, financial system and markets are working. As I look at it, a lot of the Dodd-Frank post-financial crisis reforms, I think, larger capital requirements, some basic controls on derivatives and where they're settled and cleared, it's holding up. Now, if we see further contagion in areas like commercial mortgage, backed securities and derivatives related to that, or if the economy completely spirals out of control, maybe we can see some bank failures. I guess we've already seen a couple of small bank failures in local markets. But the rebooting of the financial system is, I think, one of the stewardship success stories we've witnessed over the last decade. I mean, private sector, the regulators, congressional leaders, multiple presidents have all worked together to put the financial system on safer, sounder, more solid footing. So that so far, yes, we've had a 30+% drawdown, but the system's working. And I think that's a good story that should get told more. Do you agree with that? And do you think going beyond that, do you think there's any opportunity this time around to rehabilitate the financial services brand? You know, are there things we can do as an industry, as a sector of the economy in this crisis to improve our brand versus all the things we did last time that destroyed it?
Right.
Or destroyed
Yeah.
it.
Yeah. And I think, listen, I have to, as someone who, I feel, John, you and I feel the same way, which is that Wall Street, I feel very strongly, and I'm not afraid to tell this to anyone, that I feel serves an extremely important social purpose, and which in terms of creating capital and allowing people to access capital and to breathe dreams, breathe life into dreams that people have. And it's part of the reason why I think America has been such an enormous success story, because of the depth of its financial institutions, the depth of its financial markets. Again, I think I think what you said was right. I think no one really enjoyed the Dodd-Frank and the heavy hand of regulation. By the same token, it's the good news is and this is another enormous difference between now and the 30s, is that the banking system is extremely well capitalized. And so I think there's a lot that can be done in terms of small business loans, working hard to get, making sure, which is, and again, it sounds cliche, it sounds corny, but it is 50% of the labor force works for small and medium-sized businesses. So to the extent to which they can administer those small business loans that are being offered through SBA loans, that are being offered through the local banks, to the extent to which they can work hard to get those out to folks, it's an enormous opportunity to rehabilitate I think the financial sector, which I think justifiably took some criticism in 2008. I think it's absolutely makes sense. It's interesting too, is another sector that's not particularly well liked. Pharmaceuticals is another, and I'm no expert there, but that's another industry group which I think people are looking at a little bit more charitably now than perhaps they were 6 months ago. And so there are opportunities, I think, to rehabilitate the role of finance in helping people through very, very difficult times. So I'm sure a lot of companies are going to do that. I think the federal government is helping too. They need to help a little bit in terms of some of the regulatory changes, in terms of what are considered bad loans, what are considered capital, all of those things. To the extent to which the federal government can help out with that, it would help the banks do what they need to do to keep people afloat.
Well, I wish we had more time to explore this, Mark and Chris, but we're nearing the top of the hour. I want to be respectful of everyone's time. Jason, I just want to thank you. I know this is probably the fourth or fifth conference call or Zoom call you've been on today, and you'll have many more before the sun sets. Thank you for supporting the CFA Society of Minnesota. And Chris and Mark, back to you. I hope this has been helpful to your members, and look forward to seeing you again for 2021's Putting Investors First month.
Sounds good. Chris, do you have anything else that you wanted to add at this point?
No, I would just say again, thanks, Jason, thanks, John, and thanks for the other 70 some odd people that were on here. realize it was a little clunky, so appreciate your willingness to work through this with us. This is our, like I said, our first real one of these. Luckily, Jason and John, I think, are pros at this point, so the main speakers did their job, and hopefully next time we'll be a little smoother on our end. So thanks again to everybody.
Yeah, we'll do our best. And the only question I had, Jason, one of them came in really early, about the trophy shark mounted behind you.
Yeah, no.
The question is, does that speak to your investment philosophy?
Yeah, no, it has nothing. So Jaws is one of my favorite movies of all time. This is actually an Italian movie poster. It's the Jaws movie poster from Italy. I spent a lot of time in Italy. So, and then I loved it so much. I found one of these at like a garage sale. It cost me like $30 or something. So, and I had to have somebody help me hang it. But yeah, no, it really is just, yeah. I've never caught a shark, unfortunately. I wish I could say that I have.
Love it. Thank you guys so much. Audience folks who are still on the line, thank you for putting up with the technical difficulties. We're keeping our fingers crossed that we'll be able to get a survey, evaluation out to you folks and let you chime in there. Sorry, we did not have time to get to every last question, but we'll try and figure some of that stuff out for the next time we get together. So stay healthy, stay safe, stay away, and talk to you next time. Bye-bye. All right. Good morning, everybody. It is the stroke of 11. We want to be prompt and respectful of everybody's time. Glad you all made it. Thank you for coming. This is Mark Salter, the Executive Director for CFA Society Minnesota. I'm going to talk really briefly and then turn it over to the people you really want to hear from. Get out of the way and turn it over to Chris May, our CFA Society Minnesota President. Chris, all yours.